Hi, my name is Mike Tusaw. I'm a financial advisor from St. Charles Wealth Management. Today we're going to discuss selling a put spread. Now, selling a put spread, it's a strategy with which you typically want to do for income. Of course, you can sell a put spread and get some type of gains from it when the market goes higher based upon where you select your strike prices. But today we're going to show doing it while it's out of the money and we're looking to collect some premium. Now, a couple things to think about when selling a put spread. First off, what is your sentiment? Well, your sentiment needs to be what I like to refer to as bullish neutral, meaning you think if anything, the stock's going to go up. It might not move very much, but it's definitely not a bearish sentiment. However, if you think the stock's going to go up two or threefold, selling a put spread is probably not the right match to your sentiment. You may just want to buy the stock or maybe buy some out of the money calls or something along those lines. The second thing I want to remind you of when selling a put spread would be you typically, or what I like to do is I typically like to sell them on a down day in the market. That way, if the market continues to go down, you already have one down day out of the way and you're taking advantage of hopefully buying a dip. Now, is that a guarantee the market's going to reverse? Absolutely not. But I typically like to make the market get an extra day in to beat me at selling a put spread. Next thing that I like to look for is I like to see higher implied volatility when I sell a put spread. That way I can get more money for it. And then the final thing that I really like to look for when selling a put spread is the likelihood of it staying out of the money. Typically, I like to say I have two rules when I sell put spreads. Rule number one, never allow it to go in the money. Rule number two, don't forget rule number one. If that's the case, I feel very comfortable selling put spreads. Now, there are times where I would let it go in the money if I have it hedged, but that's a topic for another day. So let's take a look at this example that we've come up with and dive into the put spread. Now, let's take a look at this example. On this screen, you're seeing good old XYZ stock. The stock's trading at $50 per share. And in looking at the stock, you believe that it's going to stay above 45. It may not go up a ton, but you really don't see it going below $45 per share. And so if that's where your belief is, let's say the stock's had a down day, I might look for something like this. And implied volatility is high enough to do this. Now, in terms of the time frame selection of this, feel free to visit our time frame selection video, also on the YouTube channel. But for right now, we're just going to, usually I do these maybe 1 to 2 months out. If XYZ is at 50, I see that the 45 put is trading for $3.45 per contract. And so if I were to sell that, I would get $3.45. However, the problem is that I have risk all the way down to zero, and I'm not really comfortable with that, let's say. So I will simultaneously buy a 40 put for, in this example, $2.45 per contract. So what that does is that gives me a net credit of $1 on this spread. So long as the stock stays above 45 between now and expiration, whenever that may be, I'm going to be $1 richer. Of course, you multiply this by 100 in option trading. But with that, you're viewing the expiration risk reward graph of a vertical put spread. If the stock's at 50, so whether it's at 45.01 or $10,000 per share, the most I can make on this is $100. Now, 45 is the magic number here. If it goes to 44, that's my break-even point. That's why you see the little E on the screen there, because of the fact that I have that $100 credit. If it goes down $1 below where my short strike is, that's where I would break even at expiration. And then as we go lower, regardless of how low it goes, the most I can possibly lose on this is $400. And this is assuming a one lot for this put spread. So a couple things with this. Like I said earlier, one of the rules that I like to follow with this is rule number one, never let it go in the money. Rule number two, don't forget rule number one. Well, if we start getting closer to the 45 level, a lot of times I'll roll down the spread, maybe roll it out, whatever the case may be, or just get out of it for a loss. I don't want to lose $400 on a trade. If I'm consistently risking $400 to make $100, I better be right an awful lot. And I'm not that smart, and I don't know of anyone who is, quite frankly. So I typically like to get out of these before they go in the money. Also, let's say the stock were to go higher. As I've said in other videos of closing short options, usually if I can close this out for $20, that's when I would get out of it. Meaning I've gotten 80% of the net credit with which I was looking for. That's when I like to get out and take a profit. And so that's kind of where it goes with this. What you're seeing on the screen right here is an expiration day risk reward. Most of the time, you're going to be out of this trade, or most successful traders get out of this trade before expiration, for better or for worse. This is just a way with which you can see how it would work if you were to hold it until expiration. Once again, I typically don't recommend holding spreads until expiration. The other reason, or the main reason for that, would be if you actually have it expire at $43 per share, let's say, you're thinking, oh, I have downside protection. Well, yes and no. The stock will get assigned to you on expiration, but then over the weekend, if the stock goes to 20 or 10 or something like that, you're going to be on the hook for that because your 40 put will have already expired. So once again, 99% of the time, I'm out of these before expiration, and probably 99.9% of the time. This is just an illustration to give you an idea of the concept of how a trade like this would work. If you enjoyed or learned something from today's video, please subscribe. That's how our content gets out to more people. If you're looking for a financial advisor who works with put spreads very frequently, feel free to reach out to me. I'd love to have a conversation. You can go to my website, stcharleswealth.com, and set up a phone appointment with me, or you can also follow me on Twitter. I try to put out as much content as possible. Thank you and have a wonderful day.